Could the upcoming housing crash be worse than in 2008? That's the question we're delving into today. The economic landscape is rife with queries, speculations, and experts trying to decipher the future trajectory of the housing market. Whether you're an economist or simply curious, the indicators are clear, but they're not the only things we'll consider. Today, we're going to delve deep into the world of economics, finance, and real estate to bring these indicators into focus. The US housing market is showing signs of weakening, a fact that is not lost on industry experts and economists. Profit margins on home sales are shrinking. Homeowners, realtors, and investors are feeling the pinch as the once profitable market begins to wane. But what does this really mean for the average American? Is home ownership becoming less attainable, or are we just witnessing a normal market adjustment? These are important questions we need address. Home prices, a key indicator of market health, are also falling. This can be a double-edged sword. On one hand, it may make homes more affordable for first-time buyers or those looking to upgrade. However, for homeowners, it means the value of their investment is decreasing. It's a precarious balance and one that has repercussions on the wider economy. Lumber prices, often seen as a barometer for the health of the housing market, have also dropped. This may seem like an insignificant detail to some, but for those in the know, it's a red flag. Lower lumber prices mean a decreased demand new construction, one of the key drivers of the housing market. It's a ripple effect that can impact job sectors, from construction workers to architects. The alarm bells are ringing, with experts warning of a potential housing bubble in the next decade. This isn't just a case of crying wolf. These claims are backed by data and industry trends. Demographic shifts are at the heart of this potential bubble. As baby boomers retire and downscale, and as millennials struggle with debt, the demand for housing could be in flux. A housing bubble isn't just about prices dropping or profits shrinking. It's a complex web of factors, including wage stagnation, increased cost of living, and changes in population dynamics. This is a phenomenon that could echo the housing crash of 2008, which saw the average home price in the US drop by more than 20%. The 2008 housing crisis left a deep scar on the global economy, and the mere suggestion of a repeat is enough to cause concern. But this time around, we are better prepared. Economists, policymakers, and financial institutions are keeping a close eye on the situation, ready to intervene if necessary. In the midst of all these concerns, it's important to remember that the housing market is not stagnant. It evolves and adjusts, often in response to broader economic conditions. As we navigate the uncertainty, it's crucial to stay informed, make smart financial decisions, and remain hopeful. Could the upcoming housing crash be worse than in 2008? It's a question that remains unanswered. It's a phenomenon that could echo the housing crash of 2008, which saw the average home price in the US drop by more than 20%. As we navigate the complexities of the housing market, we can only hope to be better prepared for whatever comes our way. So, what makes the upcoming crash potentially worse? One factor is the state of the US economy. While the housing market appears to be cooling, the stock market is also showing signs of instability. Predictions abound of a recession and a significant crash in the S&P 500. These factors combined could create a perfect storm for a housing crash, far worse than in 2008. Furthermore, economists point to the lingering effects of the COVID-19 pandemic. The pandemic has caused inflation to reach a 40-year high, disrupted supply chains, and created a surplus of inventory. These factors could potentially exacerbate a housing crash, causing it to be more severe than the one experienced in 2008. However, it's not all doom and gloom. The strong labor market, with its low unemployment rates and high job openings, could help to mitigate the effects of a housing crash.